Hello, everybody. This is Jason, the Wizard of Ops. Here is Hunter Edmonds, a Volland quant. And we are going to talk today about our Volland 0 DTE paradigms, the new ones that we released last week. So first thing I want to mention, as we're learning about these paradigms, is that the paradigms themselves did not change. Everything is the same. What we've tried to do is make more granular paradigms on the 0 DTE page, not necessarily to reduce confusion, but to get more granular so that you can make better trading decisions. I have Hunter on because he is able to identify these paradigms as they happen in the order book. And so, Hunter, nice to have you, man.
Thanks for having me.
Yeah. Like I said, Hunter also very much knows about these paradigms. We've built them even together. So I do want to walk through, obviously the four paradigms. What, in your vision, are these four paradigms? How do you see them when you are doing your trades?
So when I'm looking at the sort of our main four paradigms, I see our GEX, AG scenarios. Those are more of our long only strategy, short only strategy. And really with those, I see it like a risk on trade, or it's a risk on long trade, or a risk off sort of mean reversion trade. For an AG, I see that as a risk on short trade or a risk off just sort of short term mean reversion. And legging into the Bank of America paradigm, that's really our core mean reversion. Dealers are short the straddle. They don't. They want to compress volatility, and Sidial is the other half of that, which is dealers are long the straddle essentially, and they really want to push the edges of realized volatility. So we really have core trades around mean reversion, and we have a core group around trend trades.
Agreed. I mean, these are dealer book paradigms, and they have certain principles that Hunter just laid out. As far, they have certain ways of trading and hedging these different
Mhm.
paradigms that they have on their book. So what we wanted to do was walk through each of these paradigms, both in footprint and in Volland. You guys do, kind of know now what JEX looks like normally, what Bank of America looks like normally. But when we get to a point when, you're testing a JEX line in the sand or coming up to a target, it doesn't look like that in the exposure chart. It looks like Bank of America, but it's not really. It's actually a target being acquired by JEX or something like that. And what we tried to do with these new paradigms by using out of the money and in the money options, we have tried to make the Volland more granular so that you can identify, because these do have different principles, right?
Mhm.
I mean,
Mhm.
they react differently. I want to walk through first how we calculated these different paradigm changes and what each of the labels mean. When we have a JEX paradigm, the JEX pure paradigm is what we know, as the regular JEX paradigm. It is
Mhm.
pure because the out of the money options, out of the money calls, out of the money puts are the primary contributors of charm. When they are not the primary contributors of charm, let's say like it's an in the money put that becomes a primary contributor, but it looks like a JEX. That is a different paradigm. That is a line in the sand test for, I think, Bank of America, right?
Mhm.
So the basis of our calculations is where is most of the charm being contributed? If it's out of the money options, then it's pure. And that goes for all four paradigms, JEX, anti-JEX, Sidial, and
Mhm.
Bank of America. But if they start being in the money, right? If you have, like, say, the JEX paradigm and you're going and you're got a mirror on the camera, right? You're going up and you're matching the target, it's going to start looking like this, right?
Mhm.
But this is not from out of the money options. These are from in the money calls, right?
Mhm.
So it looks like a Bank of America, but it is not Bank of America. It is a JEX target. And so when you see JEX target, that's the scenario that you're in. It is not the Bank of America paradigm. It's a JEX paradigm, but at an upper extreme.
Mhm.
Um, Same is true if you're at a JEX line in the sand, it starts marching down, right? And then it
Mhm.
looks like this because you're at the line in the sand.
Mhm.
That is it looks like Sidial, but it is not. It is a JEX line in the sand test.
Mhm.
What we've realized is that as we get more granular, it is not a single strike anymore. We kind of have like a range of strikes. That is that is the new kind of nomenclature. So you see Jack's line in the
Mhm.
sand. Now there are times when like it's Jack's, but it's not really like this. It's kind of like this or something.
Mhm.
And if we're started to marching down, then it kind of looks like like this, or and it may throw off the formula a little bit if you're like on the boundary.
Mhm.
Um, you get, so yeah, you may see like Bank of America line in the sand, but that's
Yep.
because, there's barely any. Today was a good example of, today's July
Mhm.
25th, 2024. Today's chart was a good example of when there was a lot of different in the money and out of the money option positioning, but it wasn't
Yep.
very robust. So you got a lot of weird different paradigms. You would get that with the old paradigm thing too. Essentially, pure is you trade on it like you always have known. When you see something that's a line in the sand test, obviously it's Bank of America, GEX or anti-GEX,
Mhm.
you know how to trade that. We talked about line in the sand all the time. We talk about targets all the time as well. We also have the tag messy, and that is when in the money options on both sides are contributing to that charm profile. I think today we had a couple messy, July 25th, 2024. We had a couple of messy paradigms where I think it was like Sidial messy. It's whipsaw on top of whipsaw. When you see messy, you could expect a lot of whipsaw because you're going to see in the money options tend to have a gamma component that is profound as well. You're going to see a lot of whipsaw, and we saw that today in
Mhm.
July 25th. That's kind of how the calculations are done. And those are the paradigms to look out for. We also have on Sidial in particular, we have Sidial Extreme, and these are the areas in which dealers want to either push the trend or get down. Really, on Sidial, in any sense, they are trying to whipsaw the market because their dynamic delta hedging makes them money the more the market moves. When you see extreme, that means up at this point in time, they're making more on the realized option expiration, their exercise, than they paid out on their premiums. So
Mhm.
that is the Citial extreme. I think that's a good high level explanation of how these paradigms and how the new labels stack up. Would you say, Hunter, do you have anything to add?
I guess one thing I'd like to be covered is, what do we really define as like a target and a line in the sand? What do we expect dealers to do at this line in the sand? What do we expect them to do at a target? Do we expect them to change behavior, from what they were originally doing?
Yeah, so before we talk about like how they are changing behavior, I do want to talk because we did change the calculations on the line in the sand and the targets. We made them a lot more granular. You notice that they're down to the dollar now. They're not just, these $5 things. The old calculation was just basically the longest strike. At the time, we didn't have the capability to calculate these things more granularly. But now we do. Essentially, what we built behind the scenes anyway is a way of calculating at least the beginning of these lines in the sands and targets. So when you see a line in the sand and the target on the screen, that is the beginning of a test, right?
Mhm.
You're getting close, I guess you
Yep.
could say, right? Or very close, right? Like that's a good time to institute a line in the sand kind of trade. Yeah, I mean, and the way we do it, just like in shorthand form, we incrementally calculate paradigms up and down the option chain. And, on each dollar, recalculating the net charm and identify where that line in the sand and targets start and end. It is a lot more sophisticated and a lot more granular, even though it doesn't seem like that because now we have like a range of lines in the sand as
Mhm.
opposed to the beginning. It's definitely actionable. You kind of have to make a trade plan, but when you see that line in the sand coming up, you can make a trade from that point, maybe a
Mhm.
little bit below. You can definitely, it is definitely actionable. So that's how we identify the lines in the sands and the targets. And so I think what Hunter and I are going to do at this point is we're going to take each of these paradigms. We're going to tell you what the dealer activity is at lines in the sand, target, and how they're going to be doing things. And then Hunter is going to show you in footprint how the thesis that I present on how dealers are doing this, and he'll show it play out in footprint. So which way do you want to start, man? Which
Um, let's
when
go
do
ahead
you
and
want to
start out
start?
with GEX.
All right.
That'd be the most frequent one we see. I made a last minute audible audible to change it. I believe we're going to use some additional references. I have Dr. Zayas's reference right here from the day.
Nice.
So really basing these around the zero DTE alerts and sort of real time what we're seeing. And it's really good to get an idea of what we're posting in real time. It's not sort of looking back, but really what I want to talk about is connecting order flow to sort of zero DTE dealers and really trying to pair together some factors that help us make high confidence trades. Yeah, we'll start with GEX. Just a quick overview, right quick. This is what a footprint chart looks like. This is what I mainly work with day to day. On the right side of my screen here, we have a market profile. This left side right here is what we call a TPO profile. The right side is a volume profile. And overlaid, the blue and red is volume by delta. Delta, when we're looking at futures, is positive delta is a market buy order. Negative delta is a market sell order. Two parts to the transaction. To every buyer, there is a seller. So there's a limit seller to a market buyer, vice versa. The easiest way when we're looking at this intraday is trying to look at how are the participants trading, who are the participants. That's probably one of the biggest things that I take away from Volland is, these specific levels, when you're sitting here looking at numbers all day, you don't know who's behind the numbers, right? Whether that is your friend Bob or whether that is Bank of America, maybe JP Morgan. We don't know who's behind it. But what really connects the dots is when we look at Volland, right? We have the zero DTE dealers inventory. We see what's on their current books. We sort of know their levels at which they have to change behavior. And so an easy way that I like to look at this is I really like to look at, how Delta is moving price. Limit orders don't really move the market. It's market buy orders, market sell orders. And so when we see a lot of positive delta in here, when it really drives price up, that's what we expect. But there are occasions where we see, just a quick example, 1030, where we have a lot of positive delta come in, 740, and somehow the market just didn't go up. So that tells me there's a big limit seller in the market. Vice versa, if we're down here at the bottom and we have a lot of negative delta and the bar goes up, there's just a big limit buyer. And so what I really try to connect the dots with here is trying to connect how these different participants are coming in the market, whether they are very passive, whether they're very aggressive, and sort of what levels they're stepping in at. And so when we really connect the dots with Volland, and I'm going to bring the screenshot back up from Dr. Zayas. When we look at a GEX, we understand that dealers are mainly short puts, long calls, right?
That's correct.
So what does that trade look like on the dealer side, if they're hedging throughout the day?
Yeah, so I mean, short puts and long calls, dealers are very positive delta. When those trades are put on, they're hedging probably immediately with short deltas. Now, when a customer puts on those trades and it's long puts and short calls, they're usually fully hedging a position. For example, if I use Apple, I mean, we're looking at ES here, but like if Apple, I would have 100 shares, I would buy a put and I would sell a call, and that limits my risk. But we increasingly see this behavior intraday on the zero DTE on SPX using ES as the underline. When you see something like that in Volland, and we measure it in SPX, but ES is the underlying. What would be 2 contracts ES, right? For every one option in SPX. What's probably happening is customers are long an SPX put and short a call. On the dealer side, they receive only the option side of that. They're not showing the future side of that. And so when they hedge, they have a full book, but they would hedge, say, 1 ES contract. So even though, the dealers would be selling in that scenario, the market's still going up because there's a buy of 2 ES and then a sale of 1 ES. And eventually at the end of the day, that 1 ES contract gets, assuming that we don't drop below the put, that 1 ES contract is bought back. In the end, there's like 2 ES contracts. It's actually a long trade. But the fact that the dealers have to hedge that collar gives us time to kind of catch up to the full realization of that trade.
So what would we expect as we get like closer to the line in the sand, or what would we expect the change to be like so we get closer to the target?
Right. So a quick review of the line in the sand of like how the dealers would deal with it is the line in the sand, that I gave a simplistic, one contract thing, but dealers obviously have millions of contracts on their book. And I think like intraday on SPX, you'd have, I guess I think it's like 3 million total SPX contracts traded on average every day. And I think like 1 to 1.25 is 0 DTE.
Mhm.
Something like that. As a review, the line in the sand is the point where the price starts coming down toward that put area. Obviously, dealers and these collar participants are not the only participants in the market. There could be sellers from elsewhere. As if the market sells off into the middle of those customer long puts, dealer short puts, dealers have to make a decision. They are
Mhm.
short those puts and they have to decide whether they are going to hedge by selling a lot more in order to account for further downside, or essentially defend their position and start holding fast and buying and kind of
Mhm.
allowing a bounce. Dealers also warehouse a lot of their Vega exposure. These GEX paradigms typically are positive dealer premium.
Mhm.
And so when they hedge by buying off of the line in the sand, it is to defend their premium. So it's not like a completely blind thing.
Mhm.
The other thing about market makers is they see the whole book before we do. They see it even before Hunter does. So
They're in the
they know
matrix.
where the momentum is coming and they know what decision to make.
Mhm.
But if the decision is made to gamma hedge and allow the market to go further down, our research and market maker friends kind of told us that they gamma hedge 3 times the amount of gamma that they need.
Mhm.
And that's because it allows for more momentum. These dealers are major players, so they're probably being the market at that
Yep.
time. And you can identify this, looking at just a candlestick chart. When you see like a large move relative to prior volatility, and it comes at a complete stop, and then you just end up with flat for like 2 or 3 ticks, 2 or 3 candles. When the dealer reaches the line in the sand, I expect more often than not to see a small bounce, say at least a small bounce, as the market gets back into their positive premium. Or if they decide to, and like volatility is too high, I would expect to see that one big candle down and then flat for a little bit as everybody digests what this big player just did.
Mhm.
So how do you see that in footprint?
Right here we have the example. This is from June 25th, 2024. Um,
Mhm.
right here, we sort of have the line in the sand down here by 54.50. And what I want to do is kind of look at these. Is on here, we have the line in the sand at 54.50. We also have a 54.65 target and a 54.70 target. And even the sort of the new calculation at the time, putting all the way up to 54.80. And so really just want to go through the footprint side, what it looks like on the tape and looks like on Delta. And the thing to remember is that Delta is market buys and market sells. That's sort of our aggressive participant. What I really like observing here is the change in tape, change in behavior of order flow. When
Mhm.
we see sort of where something becomes very aggressively sold to where that one participant just he steps in, right? And that's what I thought this would be a great example. So I'm gonna come over here and right here around was this after lunch, 12:45 going into 1 o'clock. See what that looks like. So this is ES. I know that we have SPX, but you can see how it looks very it's just lined up right here. We see the line in the sand's right this 55.15 area. Does that look about the same?
Yeah. Mhm.
And so
We'll use the candles to measure.
a thing to note right off the back is that the line in the sand, that's where most of your volume comes in. So this left side is volume. This little box on the left side, that is where the most volume occurred at, right?
Mm.
And then we also see the right side is delta. So when we see sort of an imbalance like this, there was a lot more market sellers at that level than there were market buyers. And this red box is like where the most sellers were. The blue box where the most buyers were. And we just really want to see this sort of distribution. So I'm going to bring this back up where the line in the sand was, and then kind of look at it side by side. So
Okay.
a thing to note too, right off the back, is I like the understanding of the market. The market goes from liquidity to liquidity, right? Where it sort of lacks interest on one side, it'll go test the other side. And so, right off the back, we really need to get over 54.65. I remember this day. It just was lack of interest of higher buyers. If you're shorting the market, right, you're just a future buyer. That's the way I look at it. So what better than to get a player really short so that you can take it higher? As these dealers are really short these puts, right? That's a lot of positive delta. As you come down, you're getting more positive delta, right?
Mhm.
And so dealers are getting more and more short. So they're almost pressing into this short, right? And so we can see that, as this really gets to the line in the sand, we have a lot of aggressive delta. not much positive delta at all. So there's a lot of market selling, just market selling until you sort of run into a wall at the, at our line in the sand, right? And so
Mhm.
really, once you hit this line in the sand, dealers have to make a decision. Do we keep shorting? Do we short even more to carry the market lower? Or do we start covering?
Yeah, I think though, as a quick correction, and I kind of that by, but I rethought it. It's probably not dealers that are taking it to the line in the sand. They want it flat because they're making premium on that. But it's probably somebody else that's bringing it down to the line in the sand. But then at the line in the sand, you're right. They have to make a decision, and I think that's where we're getting at now.
So what I really like seeing here is, the amount of selling at this line in the sand that just goes nowhere. Typically, if I'm short the market and, I'm trying to get down to a lower target, right? And I want to cover, I'm going to put in a limit buy order, right? And so I can just
Yeah,
sit here at the line in the sand and I could just sit here as a limit buy order. You see all this negative delta just clustered right here, a lot of volume. And so you're really getting stuck. And so typically I look at this as divergence. It's not technically divergence, but where we would see a negative delta come in, they tried means negative 1100. This is session delta. So from
mhm,
930 to current, which is at 1245, we're on negative 1100 delta. So that's just a lot of selling compared to where you're at around 5100. And so they sold off a lot and then really a lot more selling, but you got not far results. So it's effort without results. That's the big topic I look at in order flow. And so a lot of selling, pushing in the pit, and what do you know? We got nowhere, right? So now it's all about just
sure,
defending this line. And so
right.
you go from a negative 1100, get all the way to negative 2000, almost double the session delta, and you go nowhere. So what does that really tell me? There's a
That's
lot of
incredible.
a lot of selling, over 1,000 contracts in this period right here, and you only moved what from 17 down to 15 roughly. So only 2 to 3 points off of 1,000 contracts getting sold, market sell. So it's like you're not really moving very far. So it's either you have a big participant come in to keep on selling. I wouldn't advise selling the line in the sand on GEX. This is not my cup of tea. But we really get to a point where charm kicks in, it just accelerates past 1 o'clock. That's where
Mhm.
you coined the term dealer o'clock, right?
Yeah.
So now, dealers are short. Got a
You
lot of
can't say it.
positive.
Happy hour is dealer o'clock.
And so now we really see the change in pace. I know this is, look back, but at the
Yeah.
time, let's just look at what we posted at the time. Here's the line in the sand. Could not SPX could not conquer 54.65. I'm leaning
Mhm.
bullish from the line in the sand. So it's like, sort of stay risk off. I'm putting on risk at the line in the sand so we can go higher. And that's exactly how the dealers played in the scenario. And this was
Mm.
posted, right before the line in the sand test.
Yeah.
So
So did you see were there like a lot of limit orders you saw that dealers couldn't move past that area at the time? I
yeah,
mean,
so
obviously that's what your update said, but
So, at the time, what I see a lot of negative delta at the bottom, a lot of negative delta. I mean, that kind of tells me shorts are getting stuck, right? Effort
mm,
without results. And that means that to every market seller that's very aggressive, there is a market buyer. And so on this side, I'm really, I have a level from Volland. I have it. It's the line in the sand during a GEX. I see
mm,
that shorts are really getting stuck. I see that there's some big limit orders coming in to absorb all this selling. And so right now, what I'm waiting for is just those sellers to become future buyers now. And so typically, if shorts get stuck right here, well, they're going to have a tight leash on it because if you
mhm,
don't keep on getting 5, 10 points down, they're going to cover, and that's going to be your liquidity to take the market higher. What I
wow.
like to see off this is, look how much this 900 delta moved this candle up from 13 all the way up
Mhm,
to 17. So 4 points off 1,000 delta, a lot more damage than this. I typically like
yeah.
to see the market moves in the path of least resistance. And
Yeah,
so
I mean that's incredible to see that line in the sand test.
then now you
I
see
mean,
how
that's
the pace of deltas just come out. You see extreme amount
yeah,
of delta come in, and now you're just starting to work higher. The good thing
yeah,
is that we know that the dealers have to cover by end of day.
yeah,
So that's what really makes these targets good to get behind. The good thing
yeah.
is too is thing I've really noticed is when dealers are coming in to cover their short, right? They'll just put limit buy orders on the market to work the price up. So you kind of looking back down here where we see it where all this concentrated selling is, it's at the line in the sand. They're shorting the line in the sand on the
Right.
GEX. And so right here, they're stepping in, putting limit buy orders in. They're covering, just absorbing all the selling continually. So
Yeah.
then they just get stuck. This is
Wow.
the case right here. You have 460 contracts right there. That's a lot of it's a lot of selling that didn't get anywhere.
Yeah.
So
Wow. So I also noticed on Dr. Zayas's chart that we had sort of like a target kind of test too. Is that on this? Is this an example of that, or
or targets right here. Sort of just trying to match candles, it looks like.
yeah?
Targets, we'll see a lot of limit selling right there, a
Hmm.
lot of limit buy, a lot of limit activity. At the line of sand, we expect dealers to be more aggressive, right? We'll start
Hmm.
seeing them, layer in limit buy orders. They'll start market ordering up, and they'll really
Hmm.
start driving price. Even during a GEX like this, we'll see them actually put, sort of stack the bid, right? They're just stacking the bid, trying to move the market higher. If you want to sell, great, we'll buy it off your hands. If you really need to short, right?
Yeah, I think the dynamic there is as charm is declining, dealers have to release those hedges that they initially put on when the trade was put on. The deltas are squeezing down from 30, 40 on those out of the money long calls, and they're squeezing down towards zero. That limit buy order kind of keeps moving up. So yeah, I think the dynamic there is actually dealers. So and it's just kind of interjecting there. But and then that dynamic stops when they get to the target. Like the target is the area where, if they naturally hedge their charm, the
Mhm.
target is where they end up.
So walk me through like what that looks like. You're getting to the end of the day, you're going to a GEX target. What does that long call look like on your
So
books?
on their books, it's going to look the same. I mean, we've noticed that there's a lot of trading in the beginning of the day,
Hmm.
and there's a little bit of trading at the end of the day, but that's mostly like the hedging underlying trading.
Hmm.
On their books, they see, if they're short puts and long calls, and they see maybe a total of, 50 deltas there, 60 deltas,
Yep.
something like that. And let's say the price doesn't move, or we move very slowly. If I were to look at Dr. Z's area here, I would say it's like the 1330 to 1400 area, where we don't really move very much. We are
Hmm.
between the target and the line in the sand. They want to collect theta. Their business model is to collect the difference between the bid and the ask on trades.
Hmm.
But if you're going to give them free theta, then they'll take it. So, if nothing's happening and eventually they're getting toward the end of the day, they don't
Hmm.
want to be exposed to that kind of risk anymore, or they're not
Hmm.
exposed as much to as much risk as they were in the beginning of the day.
Hmm.
They're going to start taking those hedges off and collecting that theta.
I like to look at the target as like if they have a lot of inventory in that long call strike, that's sort of
Mhm.
their collateral to quote against. If you're a dealer, you like to run volume. And
Yeah.
so, what better than to sort of pin that long call strike where they have positive delta, they can short against it. And so, if it goes below, they can cover and just sort of work back and forth around that strike area.
Yeah.
To me, it's not a short. We don't short necessarily the target, but it's always a come back to level. It's sort of a
Hmm.
mean reversion target. If we get way above target, I could see the case for, okay, dealers are probably shorting into this move, come back to their long delta, but they're covered
Yeah.
either way. They can go past the target 100 points. If they're long the call and they can keep them shorting against the call, they're good. So,
Right. So yeah, I guess between us we explained GEX pure, GEX line in the sand, and GEX target. GEX messy. We've only kind of really understood the granularity of these paradigms recently, after even the white paper. But in the money options, they kind of have more of a gamma component to them,
mhm,
because they're in the money. Now like you're going to be swinging back and forth. You're going to have to hedge the deltas a lot more quickly because you have a greater exposure there. You're not
mhm.
like warehousing Vega or warehousing Theta at this point. You are in the money. So anything messy, I mean, we can. I don't know if you have a messy here, but do you have a messy example?
I don't.
Yeah, I mean,
We'll need
it's
to come
it's
back to
tough
that.
because that happens so rarely. But because of that dynamic, I think that you're going to see a lot more whipsaw and a lot, market orders swinging things back and forth. It's going to be tough to track.
So to me, kind of just wrapping this up from a GEX side is during the line of sand, we expect bids to really step in a lot of people sort of market selling into that target. We expect dealers to start covering, adding, stacking bids to where you could just market sell all you want to. You're just not going to get that far. Effort without results. And so as they start covering, we expect them to start stacking bids and being supportive of price going higher. At the sort of targets on GEX, we expect them to transact volume there. And so it's not necessarily what we call a directional trade. It's more, it's almost like volatility, right? Volatility is compressing. That's what we expect there. Volume to
Yeah.
increase, liquidity to increase. That's just a couple of points to nail at the line in the sand and the target for GEX.
All right. All right. So let's go to B of A. I think using that kind of framework, I mean, now we could probably just fly through the other paradigms, right? Because
Yeah.
we explained how a line in the sand looks like for GEX. It's going to look similar in a Bank of America, right?
Bank of America is a tad bit different. This is sort of a short volatility trade, right? We want to
Mhm.
step in and warehouse risk at below value, sort of want to warehouse short above value, right? We're just playing back to the center of the distribution. I like to
Mhm.
look at it as like a skewed bell curve, right? When we
So when you
see,
see, like, I saw the Dr. Zayas and the example that you had that we tested a line in the sand in the B of A. How is that different than a GEX line in the sand test?
so a GEX line in the sand, we'll see the dealers become much more aggressive as they hit the line in the sand. They absorb it initially, and then as time goes by, because charm exponentially increases with respect to time going into close from lunch to 1 o'clock to dealer o'clock power hour. So we'll see them make a decision where it's either overhead, you go past the line of sand, or sit here and say, okay, we need to start covering short, right? So we'll start seeing them buy back their shorts, and that's when they become more aggressive, right? They start crossing the spread. We'll see them start market ordering and driving price higher. So you'll
So
see
does
a
that look
lot
like a market order book or whatever?
on footprint on GEX is they become the buyer. They're the ones who's crossing above the ask. They're
Right.
taking liquidity, driving price higher, and stacks and bids. They need to get out of their shorts, right? Market's going
Mhm.
higher. Why be short if the market's going higher?
Got it. Yeah,
B
go
of
ahead.
A is where they really want to sort of warehouse more risk, right? So they're not going to necessarily be aggressive on like market buying, right? You have a line in the sand down here by 54.50, a line in the sand at 54.70, right? Initial B of A in the morning down there, they're just going to add a lot of liquidity, right? B of A is short volatility trade. So they'll just sit there and just add a lot of liquidity. You'll see a lot of bids start to stack, but they're not crossing the spread. They're not driving price back. They're just sort of wearing the participant out who's trying to play the breakout trade.
So to
So,
be clear, it's short volatility for the dealer.
right.
Yeah. And that's, named after the Bank of America paper that said that almost all zero DTE is buying. So
We see it's dealers want sort of that short volatility, right? They're short the straddle, you know, at the edges is where they really want to start providing liquidity, right? I always look at it as like a volatility to liquidity relationship. You know, more volatility, less liquidity, um, less volatility, more liquidity. And so the way to really short vol is to provide liquidity in the market. And so a lot of that is where we get down to here, where the line in the sand is. We'll see that giant passive buyers come in the case. So we see this sort of bar right here off the lower edge. We see 1013. That's right here with the timestamps. Now this is 5-point range bars. Line the timestamp up, not the bars. And there's a
right.
reason for this. It's a lot easier to see distribution of delta by range than it is by time, because time helps us understand fixed time 5 minutes, but we really see where those buyers and sellers were in this range. And so a thing to note is we see negative delta and a positive bar, right? So that tells us that all the selling did not have any results going down lower, but the bar actually turned up. So with all that aggressive market selling, people are hitting the bid, people are selling. Someone on the other side of that warehouse the risk, they purchased long. And we can see in this case, we actually know who that is, right? It's the
Hmm.
zero DTE dealers. In a Bank of
Yeah.
America, they're stepping in to absorb that selling. And they're saying, well, this is enough, that we're at the line of sand, we're going to start providing liquidity, right? So we're going to start soaking up all this short selling. People who want to break the market down lower, we're going to come in here and defend our line of sand by just providing liquidity. We're shorting volatility by killing realized volatility.
Right.
That's how I like to look at this one. Is when we get down here, dealers provide a lot of liquidity. We can see that this bottom edge, this 247 was where the most amount of selling was, just right at 5507. In this case, coming back to his, because 5450, the low was so roughly 4 points off the bottom. So in this case, we see Yeah, this is the entire line in the sand right here. And we can see the same thing again. We see another bar, which is negative delta, and it closes up. So that just tells me that they're still trying to sell the low, trying to break the market lower, and the dealers are passive buyer. So a seasonality or thing that we really want to look at is, when we get to these line in the sands on a zero DTE side, and we see it's a line in the sand on Volland, we know who is participating there, right?
Yeah,
If I see
that's true.
this anywhere else
Mhm.
up here, maybe it's 20 points higher. I don't know who that is, but because I have Volland and because I see the sort of the line of sand, I know who that participant is that's warehousing that risk. And
Yeah.
given that we have a zero DTE dealer coming in here warehousing risk of buying, defending the line of sand by providing liquidity, sort of playing the mean reversion trade, I'm going to lean
Mhm.
into that participant a lot more than I would just looking at it randomly elsewhere. So the edge is knowing who the participant is, who is transacting there, and then you see it on the footprint to confirm that they are there, right? I typically like to say that, I need footprint for confirmation. It's because I want to see orders transact there and see if the dealers, if I see this right here, Delta
Mhm.
divergence, I see a Bank of America line this in, this is a buy to me. And I'll wait till the bar confirms, then I'll get in.
Yeah, no, that makes total sense. I mean, it'll be the same on the upside too, even though we don't see that on that day. But yeah, so I guess the next thing is the anti-GEX, which should probably hopefully be quicker because it's just the opposite of GEX. You could just show kind of like if you want to really quick what it looks like on the anti-GEX
Well,
side.
I'll do this right quick. For Bank of America, like I said, they warehouse risk on the edge. You'll see if you have a delta profile and a market profile on the side, you'll see a large cluster of red at the bottom,
Yeah,
and know that that's your dealers. And you see a large cluster of blue above, and that's where they were limit selling. They just don't let the market break out.
got it.
Did you want to go to AG next?
Yeah, go check out AG.
I really had to dig this one up. Oh, so this is September 26th, 2023. Um,
Ancient history. Look at those
we,
4,000s. Is the market
oh,
allowed to be that low?
oh my gosh, 4,000. That's 1,000 points away, man. That shows you how long we've had an AG. It's always just been GEX. We've had more GEXs lately than anything, but coming off of GEX example, sort of how dealers were coming in to defend the line in the sand, right? And they were stacking bids, trying to work the market higher. We see the opposite side right now with AG. Dealers come in and they start defending the offers, right? So, what does
Mhm.
the AG trade look like to you as a dealer?
I mean, it's just the opposite of Jex. On the customer side, it's the opposite too. They're selling, yeah, the underlying, the customer is anyway, buying calls to hedge that and selling puts. So it's kind of the opposite, but they're definitely a short bias for one reason or another. Customers are trying to take advantage of that.
So, what does it look like as you get to the line in the sand as in AG? And then what does it look like as you get to the target on AG? What
I
does your
mean, it's the
deltas
same
look
kind of
like?
thing as Jex, it's for a line in the sand in AG, it's just, the opposite. It's they would have to gamma hedge by buying if their short calls are violated too much, which doesn't also typically happen. It actually happens. AG doesn't happen very frequently, but when you do get a line in the sand in AG, it is almost always respected, it seems. But then the AG target's kind of the same thing as that positive charm, like this.
Mm-hmm.
Declines, the natural target is where that charm kind of finishes out. Though the other thing too, though, with AG, apparently, once that short momentum starts,
Mm-hmm.
it's hard to stop even at the target. And sometimes you see targets kind of,
Yep.
a moving target, it's down, 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 down. So
Probably one of the best things I like to look at in a aggressive short trend is, when dealers come in and really start adding liquidity on the book right where price is, right? So we see sort of
mm,
delta divergence in that same case where we see a lot of positive delta, but the bar just cannot go higher. The market just can't go higher. There's a lot of people buying, and we have a dealer just sitting there covering, he's just selling via limit orders. So
mhm.
right here, we're going through an example of I think the last HE we had, which is 9 months ago. And clear anti-GEX in the morning, we have a target of 42.75, a line in the sand above 43.20. So we don't necessarily see a line in the sand, but to go back to GEX is we see heavy absorption there, and then the dealers start really aggressively selling for AG. So we'll see them absorb a lot of positive delta. And then as you just sort of trade sideways there, we'll see a lot of volume build at the line of sand. And then you'll see them start aggressively selling to defend it. That's sort of how they behave with the line in the sand. And then the target, we expect a lot of volume to transact there. And we look at that as sort of a mean reversion trade. And so we can see the market, we'll really see the market lighten up as we hit the target. Lighting up, I mean, by momentum. You'll see things get very balanced. You'll see a lot of liquidity there. And that's sort of your little high volume node here. This little edge right here means that there's just a lot of volume. That's where the most volume transacted for that day. And pretty sure that's where your target is. But
Okay.
Just look at it on the footprint side, we see heavy delta. Session delta is very red. It's a lot easy to get that momentum rolling. Everything's basically red here. 3,000 delta, it just wants the market lower. And typically these are great ones where you see the most selling at, those are the points that are most offended. That's the way I look at it. So I see it, the point of control right here at 43.43 for this bar. That's where the most selling is. They'll pretty much defend those zones.
Nice.
Wouldn't trust the buying. Those are just bounces just to reload back into this high volume selling. And
got it.
Here's a good one to note. So we see delta's 816 and the bar closed down. We see where a majority of the volume transact is up here at the edge. So this is what I kind of want to go over is we see that dealers are, even right here, almost 3,500 positive delta in the bar closed down. And so all this is just, dealers are coming in, they're putting limit sell orders on the book, and they're just letting people buy as much as they want. And they're just slowly, covering their position. So in AG, right, as charm goes throughout the day, right? How are they're having to, cover their long, right?
Yeah.
Their long deltas. As a market maker, what's the best way? You have priority in the order book. So you're just sitting there stacking limit sell to cover your short. Because
the point,
people like to buy thinking that there's not the bottom's in, buy as much as they want, offload the dealers. And we see a lot of delta divergence and the market just gets pushed lower. The dealers really kill the momentum to the upside. They keep it from going higher and just ultimately just kind of pushes down where their target is. And they just create a lot of volume right here. So this node is, 43.16. This is where all the volume transacts. So that's how I like to look at an AG trade. Same as GEX. Just watch how you're stacking the order book and moving up liquidity.
I guess really quick, just show a Sidial kind of footprint and an example if you can.
So Sidial, we still look at Sidial as a sort of a mean reversion trade, but it's a volatile mean reversion, right?
Right.
And so
from a dealer standpoint, Sidial, they are essentially long a straddle, and they would want to like dynamically delta hedge because as you're delta hedging going back and forth, the delta hedge is how you're making your money. Their ideal is to hit a trend and keep it going. Sometimes that's not the case. So any kind of whipsaw or even any kind of trend movement is what they want. Movement.
Yeah. So what I see is typically you have your bell curve distribution. With Sidial, I like to look at is there's two bell curves and the market's going to trade to one, and then the market's going to not want to doesn't like the series, so it's going to go trade to the next one. And so we see at this top level, this is sort of that upper little bell curve, and we have our lower bell curve. And we see that in a Sidial, we get that realized volatility because it trades to one, and you have this level, right? It's like, well, we're going to stay here, and then we're going to go right back to the next level, back to the next level, back to the next level. And so it's just a game of ping pong between these two levels. And a Sidial is like the opposite of B of A. It's still
right.
It doesn't want to stay in the middle. It just wants to stay at either one edge or the other. So
that's a Sidial extreme, right? Those edges.
Yeah.
And then, all right. I think this is about as thorough as we can get as far as these new paradigms or really explaining these paradigms. Thanks for listening, and may Volland help you in your trading ventures.